spot price is over the futures price.
I think we're so close to $55 last week that the market just had to.
Silver is breaking patterns nobody expected. Above $48 for the first time, outperforming Bitcoin, tens of thousands of December futures still open, and a perfect cup and handle forming right now. Squeaky Mouse posted on X. The technicals for silver tell us this time is different because for the first time ever, we're sitting above $48 instead of spiking down from it. This is a very interesting point from Squeaky Mouse. They're highlighting something that's purely technical. Historically, silver has approached the $48 level and then sharply rejected it. But this time, their observation is that silver is not spiking down, it's holding above that region. From a chart reader's perspective, holding above a historically strong line is usually seen as a shift in behavior. Again, that's not a prediction, just an interpretation of what the chart is doing right now. It's a moment many analysts are watching because long-term resistance levels tend to carry psychological importance. Jordan Roy posted, "Biggest story of the week. Gold and silver breaking out against Bitcoin. This is the biggest relative breakout since inception of Bitcoin and crypto. Gold versus Bitcoin closed at 21-month high. Silver versus Bitcoin closed at 23-month high." Jordan Roy points out something a lot of macro observers track: the performance of precious metals relative to Bitcoin. Those ratios don't get mainstream attention, but they matter to traders who follow intermarket strength. A 21-month high for gold versus Bitcoin and a 23-month high for silver versus Bitcoin is a notable shift in relative momentum. It doesn't mean any asset is better than another, just that metals have gained ground compared to Bitcoin recently. Analysts often interpret these relative breakouts as signals of shifting market preferences or liquidity flows. Rashad Hajiev wrote, "With only 4 trading days left in November, December futures still have a massive 43K silver futures contracts. Investors are trying to hang on, hoping for a silver price explosion before maturity of December 2025 contract." Rashad highlights something structural: the amount of open interest left in the December futures. Having 43,000 contracts with just a few trading days left is indeed large for this point in the cycle. His wording, "investors are trying to hang on hoping for a silver price explosion," captures a sentiment that's common around contract expiration months. It doesn't mean anything will happen, it simply reflects the emotional tone and expectations circulating in the market. Futures markets often behave differently near expiration, so analysts watch these contract flows closely to understand the mood. The Great Martis added, "Silver cup and handle update. Next week we'll confirm whether the pattern is valid or not. So far, textbook." A classic technical pattern here, the cup and handle. The Great Martis is essentially saying that the pattern still looks clean and next week may confirm whether it completes or invalidates. Technical traders love textbook shapes because they add clarity to chart interpretation. Whether it confirms or not, the key takeaway is that many chart watchers are monitoring these structures to understand the market behavior, not to predict outcomes, but to track patterns as they form. Stephanie writes, "Where paper meets physical silver. The system is breaking, trust is gone even among themselves. Physical silver is in high demand because everyone sees the writing on the wall. They have artificially kept the price of silver down ridiculous lows, faking the supply and demand with paper. But now the demand for silver to be delivered is higher than it has ever been. Delivering something that does exist because you sold paper without having the underlying asset makes delivering impossible. Failed to deliver." End quote. Stephanie also shares a short clip from Andy Schectman.
This is where you could say instead of the rubber meets the road, it's where paper meets physical. Those who want to stand for delivery can on the 28th. They don't have to do it on the 28th, but this is when typically they'll declare, yes, we're going to stand for delivery. Backwardation is something you don't see in the metals market very often. It's where the spot price is over the futures price. not under like gold and contango in normal market, but over. And that's backwardation. And it's rare, especially this close to expiration. What it basically says is someone wants physical silver now, not later, and that they see tightness in inventories and immediate demand is outpacing the expected supply. In other words, I don't care what the futures say. I will pay more for it today. I don't want to give you kind of like what the banks are saying. I don't want to wait one day. I don't want to wait any time at all. I want it right now. And this kind of spread, especially as we get close to expiration, doesn't happen unless something's off. And it usually comes right before a big move in the metals market. So I think it's interesting to see, this is what we've been talking about for a long time. Now, for a minute, we saw the market when 50 plus million ounces found their way to London. We saw the market shift from big backwardation as much as $3 an ounce to contango, as it's supposed to be, lasted not more than a day or two, if that. And now all of a sudden we're back in backwardation again. And that just simply says a lack of trust.
Andy Schectman is highlighting a rare situation in the silver market, backwardation. He explains that when the spot price is higher than the futures price, this close to expiration, it signals strong immediate demand and tight physical supply. Buyers are prioritizing right now delivery over future contracts, which points to stress in inventories. Schectman notes that this pattern often appears before major market moves, and the quick return to backwardation suggests ongoing concern and a lack of trust in the system. Mark also shared a post, Keith Neumeyer, "The silver rally is different," and shared this clip.
It's different because, I remember the move, that took place between 2009 and 2011. And, when silver broke out, through $30, back in early, I guess it was, early 2011, that whole move from $30 to $50 is basically short covering. The banks got completely caught offside. That was all paper driven. And that's why it ended so quickly, because it was driven by short covering. And this rally that we've seen over the last few months is all physical demand. And we have to see higher prices too. And I've said it a dozen times to get the miners, the mining companies, to start producing more metal to fill that gap. But we're not going to do it at $50 silver. I don't see any big mines coming. Maybe if copper prices go to $10, maybe there's going to be some silver byproduct that might come out of that. Maybe some new copper mines will get opened. I'm not aware of any that's coming. I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off to drive it down a little bit. And it's destined to go through new highs here. And, whether it hits 60, 65 by the end of the year, I wouldn't be at all surprised.
In this clip, Keith Neumeyer reflects on a period many longtime silver watchers remember well, the move between 2009 and 2011. As he explains, when silver broke out through $30 back in early 2011, that whole move from $30 to $50 was basically short covering. According to him, the banks were caught offside in the paper market, and that's why the move was sharp, and why it ended quickly. Neumeyer contrasts that historical moment with what he sees today. In his words, this rally that we've seen over the last few months is all physical demand. He emphasizes that pressures in the physical market are different from the paper-driven dynamics of the past. He also touches on the supply side, highlighting that mining companies need higher prices to justify bringing more metal to market. As he puts it, we're not going to do it at $50 silver. I'm not aware of any big mines coming. He notes that even potential increases in copper production, which can bring silver as a byproduct, depend on broader commodity conditions. Neumeyer goes on to say he expects the silver market could move into new territory, mentioning that the market recently moved close to $55 and that volatility remains part of the process. In his words, he wouldn't be at all surprised if silver touched different levels by year-end, reflecting his personal perspective, not a guarantee or a directive. This commentary highlights the contrast between past paper-driven moves and current physical market pressures, giving viewers a clear sense of how industry insiders interpret the dynamics shaping today's silver environment. It's an explanation of market forces, not financial advice, and not a recommendation to take any buying or selling action.